Hi there. Welcome to my reflections on week 4 and 5 of Institutional Investors. Again, I thought this might be helpful for you to see the context of the course and also later on to be prepared for the exam. So what do we do in week 4? So in week 4, we looked at alternative investments. And just to recap that very briefly, so typically when we say alternative investments, it means that we look at investments beyond traditional ones like bonds and equity. In week 3, we also looked at the core satellite model, and we established that core assets typically are more traditional assets which you manage passively, while the satellites are the more alternative assets where you can be active. We started by looking at private equity, which of course is the private version of your regular listed stocks. We saw that these come in two types of investments. We have buyout and venture capital types of investments. Buyout typically is concerned with companies that are already there for a while, which have stable cash flows but need a turnaround. While on the other hand, venture capital typically is a new young startup company which doesn't have any cash flows and therefore needs an injection of capital. So venture cap is much more entrepreneurial, while buyout is more existing firms. Both, however, still private, so not being listed. On the right-hand side, I put up a short table where you see some of the names of the companies involved in private equity. And I guess companies like Blackstone, KKR, Oaktree, and Bain are names that you might have seen before. So these are major firms involved in private equity. We also saw from the literature that private equity tends to outperform the public market, especially buyouts. Reasons for that are, among others, a premium for illiquidity, because private equity means your money is locked up for typically more than 10 years, which makes the investment illiquid, and investors like a premium for that, which we call an illiquidity premium. Something else is skill. It turns out to be that especially in private markets like private equity, more skilled investors are, and they can actually exploit market inefficiencies. What's also important to see, this is a long-term investment, which means that you need patient capital, typically capital by institutional investors who can sit it out for the long run. However, we have recently seen that more and more of this patient capital is flowing towards the private equity market. And at the bottom right, for instance, you see a small table by Bloomberg, which shows you for a number of years, the orange bars, which is actually the capital that's being raised, which means that investors sending money to private equity, but at the same time, the gray bar you see so-called dry powder. Dry powder is money that's been allocated before but not invested yet. So it's money waited to be invested for good opportunities to come by. So the larger the gray bar, the more money is waiting for deals. And the risk of that could be that if there's more money waiting for good deals, then people are overpaying for deals. And if you overpay for a deal, your returns might go down. So this is a result of the recent success of private equity, that there's a lot of money lying on the shelf, which we call dry powder. Then we moved on to another alternative asset, being real estate. We saw that real estate investments typically come in two forms. We have the public investments, which we also call indirect investing, and we have the so-called private investments, which we call direct investments in real estate. Some typical characteristics which are listed here give you a bit of flavor of public versus private. Now, public typically being stocks, so you invest in a company that's listed, which then invests in real estate, which means you indirectly invest in real estate, while indeed a private real estate investment typically means you buy buildings. So that's the actual bricks and mortar that you have access to. So liquidity for public is good because it's like stocks. and for private it's bad, which means it's illiquid. Diversification, now public being like stocks, of course diversification of stocks to stocks is bad, while private real estate investments typically are very good diversifiers. Inflation hedge capabilities, bad for public, because we know that stocks are not a good inflation hedge, while for private real estate investments, there's a partial hedge for inflation, which typically is baked into the rental contracts. In terms of costs, I listed as positive for public, which means costs are low for public real estate investments, because typically they're regular stocks and they're not very expensive to invest in. For private investments, costs are really high. You need different skills, you need different, let's say, layers of cost to actually be able to invest in private real estate. So high cost. Finally, skill needed. For public, I put a plus, which means that you don't need very specific skills. However, for private, you need very specific skills. So that's why I put a negative. You need more skills for private than for public. Finally, something important to also mention is that the valuation of private real estate is rather cumbersome. While for public, you can just observe a price in the market, for private real estate, you only really observe a return on an investment if you sell the investment. But being a long-term vehicle, real estate typically doesn't transact every day or every year or even not every decade. So in the meantime, if no transaction takes place, you need a valuation. Now, this valuation typically takes place once a year, and if you do that, you get a very smooth pattern. So instead of public real estate, where you get a return almost every second of the day, for private real estate, you typically only get it once a year. So if you then stack up all these returns, you get a very smooth picture. So if you look at returns of private real estate, you have to be careful because these are smoothed. Then we moved on to week 5. In week 5, we had a guest lecture by APG Asset Management on infrastructure. And I think our lecturer did an excellent job, so I won't repeat all the points that he made. But I think important for us to take away here is that infrastructure is becoming more and more important as an investment strategy. For institutional investors, it makes sense because it does provide a match for their long-term liabilities. It offers diversification, but also, as Jan-Willem Ruisbroek from APG mentioned, you're able to invest large amounts of money efficiently. So while if you buy a stock, typically, this is about, tens of dollars or hundreds. If you buy, for instance, an airport, you already talk about $1 billion or more. So if you're a large investor, you can efficiently invest large amounts in infrastructure. And on the top right figure, you see that indeed there's a large need for infrastructure investments. So thinking about airports, railroads, telecom, and power, especially in the energy transition, governments are struggling right now to actually finance these large infrastructure projects. And that's why they're looking towards private capital to actually fulfill that demand. And that's where institutional investors come in. They can finance these large infrastructure projects, and at the same time, it lines up with their long-term liabilities. But again, I think looking at Jan-Willem Ruisbroek's lecture, he gives you lots of ideas on why infrastructure might be an interesting investment. Then on Wednesday in week 5, you put it all together in the EUPF assignment, where we have an existing pension fund which invests quite boring in stocks and bonds, and you're asked as consultants to advise the board whether they should actually expand investing into so-called alternative assets. So you looked at real estate, you looked at private equity, and you looked at infrastructure. I think the most important thing that you hopefully learn from that assignment is not necessarily the exact numbers, but it's much more on how do you collect data and how do you analyze this data. And this is, I think, something that's very important also for your master thesis, which is coming up for some of you. Something also that we realized when looking at the assignments, at least I hope you realized that by looking at the assignments, is that you have to be very critical towards your results. So, of course, you used an optimizer, but when you analyze the outcome of that, be critical. Does this make sense? Is it plausible? Is it something that I can report to my client? And then, of course, I give you some ideas on how to tackle that. So, before I get to that, maybe let's try to wrap up these 2 weeks. Why is it interesting to look at alternative investments anyway? Now, first of all, it's the satellite. So we are trying to look at higher returns, both in absolute terms, but also in relative terms in trying to beat a benchmark. This is what active management is all about. Secondly, it offers diversification. As well, it gives institutional investors long-term cash flows, which line up with their long-term liabilities. It offers some inflation hedge, not for all, but some. And also a very important argument is that it completes market exposure. What I mean with that is that more recently, a lot of companies decided not to go public anymore. And by doing that, they stay private. If you then only invest in public markets, which would be your typical bonds and equities, you miss part of the market exposure. So to make sure that you also have exposure to private assets, you need to go to alternatives. On the top right, you see a snapshot of some asset allocations of typical investors. So in the middle, you see pensions. And this is, by the way, by KKR, which is a private equity firm, but still, I think it gives a nice idea. You see that, most recently, pension funds invest on average about 24% in alternatives. If you then look at the left bar, which says ultra high net worth, which means, in my words, and don't repeat this, filthy rich people, they invest much more in alternatives. And why is that? Typically, this is where the real estate investments and private equity investments sit. So these are people who invest their own money, and they have no restrictions in terms of liquidity whatsoever. So if they invest their own money, they put much more in alternatives. On the right hand side, you see HNY, which is high net worth, which is also rich people, but not as rich as the ultra rich people. They also put quite some money in alternatives. If you then look at individual investors like retail investors, they have a much lower percentage in alternatives, which is not on this graph. And that's why it's so important that in their pension funds do have exposure to alternatives. And they can do that because of their long-term horizon. However, of course, there are also disadvantages. For instance, first of all, the costs are way higher of investing in alternatives. And to give you an idea, there's something we call an FTE ratio. If a typical pension fund has maybe 20% in alternatives, typically 80% of the people working on in that particular pension fund work on these alternatives. So 20% of the money takes 80% of the FTEs, of the efforts, which means that these alternative markets actually have much higher costs because you have to do much more research and it's more complex. At the same time, it's less liquid, which is fine if you have a long-term horizon, but you have to be aware of that. They're less transparent, which again is fine if you have the research skills to do so. And actually that's also necessary to have these skills. Because of these skills, you can actually create higher returns. So all the buts here in the end should lead to higher returns. Importantly, you also need different skills. For instance, we saw from the infrastructure lecture, we saw that next to finance skills, you also need negotiation skills. And if you go into infrastructure, you might even need engineering skills. So it's a very interesting and diverse team that you need to actually create these returns. All in all, I think for you as future employees in these industries, there are loads of opportunities to go and work for companies which are on private markets. Now, finally, how to allocate to alternatives. Now, of course, it all starts with your so-called asset liability management study. Again, this is my upside-down triangle that I showed you many times. You ask the question, what's my goal? Now, my goal is, in this case, as an institutional investor, read a pension fund, you need to pay liabilities. So you know going forward how my cash flows look like, my outflows. But then I need to be sure that I know how to achieve that goal. So you need assets which make you pay these liabilities in the future. Typically, the next step is then in your analysis is you look at your so-called investment beliefs. Now, what's an investment belief? It's something that helps you in making choices on where to put the money. And to give you a flavor of that, on the right-hand side, I put a graph by Mercer. Mercer being a large consultancy firm, they also have investment beliefs. For instance, some of the beliefs they put out here is that asset allocation for them is the most important decision. Now, we talked about this in the course as well. They also put out an investment belief that ESG risks are important. And finally, they clearly speak up for active ownership, which in their opinion helps you to realize long-term value. Now, that's something we actually talk about in week 6. So these are not carved in stone, but this is something which is particular to an investor. And these beliefs, which again, these are the Mercer beliefs, but every institutional investor can have different beliefs, influences the way you actually construct your portfolio. So what do you then do next? You need to forecast returns. And that's what you did in your case. So you both looked at historical returns. You tried to extrapolate them to the future. So for instance, you knew that in the last 10 years, fixed income performed rather well because interest rates went down and existing bonds became more valuable. But what if interest rates go up again in the future because maybe inflation goes up? What would happen then to bonds? Probably bonds will perform less. Because you don't know for sure what will play out, you build scenarios. So typically you build a positive, let's say an average, and a negative scenario. And you then start running these scenarios to get to different outcomes based on past returns, trying to forecast the future. And again, as you typically know that all of these scenarios, or none of them actually, will work out in the end, you do many of them. So you get a glimpse of what's the range of possible outcomes. As soon as you have established these historical returns and risks, of course, you run a mean variance optimizer. That's what you did as well in your assignment. You do a Markowitz optimization. Very important then, what I do in practice, when I get these results back from the analyst who run this, my first question is always, does this make sense to you? So if I currently have a 60-40 allocation, 60 equities and 40 bonds, and then the optimizer tells me I should do 95 in bonds and 5 only in equities, probably I have to be, let's say, a bit critical towards these results. Do they really make sense? So what we then do in practice is we work with so-called restrictions. First of all, the obvious ones, the weights on the optimizer cannot be negative, so no shorting. They cannot be more than 100. We cannot have leverage on the total fund level. In addition to that, there are practical things, like, let's say if you today have 60-40, yeah, it's unlikely that you go to 95-5 or 100-0. So you might say, I have a maximum deviation from my current asset mix. So to keep turnover low. Turnover means buying and selling based on the new mix. Finally, also a very important one is that you put on a restriction for so-called illiquid assets. So, because if you would look at, for instance, the private assets that you put in, like private real estate, private equity, infrastructure, we all know, first of all, that these returns are smoothed. And secondly, we do know that because of that, they seem like a great diversifier. So if you then run an unconstrained optimizer, you will see that the optimizer puts a lot of weight in these illiquid assets. Now, in practice, we do restrict that for typically 2 reasons. One of them being that we know that these returns are smoothed, so we have to take them with a pinch of salt. But secondly, we also have to make sure that we have sufficient liquidity to pay our liabilities. So if tomorrow we have to pay out pensions, we can't tell people, yeah, but sorry, we put the money in private real estate and private equity. Please come back in 10 years because then we can get the money back. So that's not what's going to happen, of course. So you have to put a maximum on the number of illiquid assets, which is different for every institutional investor, but typically it would be around 20-25%. If you put on all these restrictions, then you get a new output. And in the end, that output, and that's, I think, my main takeaway for you here, is a combination of so-called science and art. And science being the mean variance optimization, and art being putting all the restrictions on and making sure this is actually practically plausible to do this. So this is what I wanted to share with you. So in week 4 and 5, we looked at in more detail how you actually translate your goal into investments, and how you can actually then also include so-called alternative investments, which seem to be very appealing for long-term investors, but it also comes with some disadvantages. And by using these different steps, you can try to take that into account. Of course, we did not expect you in your cases to do all of this correctly. I think hopefully you learned from this is that you have to be very careful and very mindful of running these types of analysis with alternative assets. And that's why we call them alternatives. Hope this is helpful for you. Take care, and see you back at the end of week 6 and 7 again.